Good morning, everyone, and welcome to Weekly Profit Talk. As you might imagine, since we do this every week, we call it Weekly Profit Talk. It happens every single week on Wednesday morning at 8:30 a.m. Mountain Time, which is right now. Good morning. And if you're on the Pacific Coast, you're seeing this at 7:30. If you're out in New York City, 10:30. So, good morning and welcome. Each week, we talk about the things that affect the profitability of your private physician practice. And this week, I want to talk about well, let's just tell you that the name of the topic is If My Practice is Profitable, Where's the Cash? Now, there's a age-old question, and it's very important to understand something. Net profit, or the amount that you have left over on your profit and loss statement after all expenses, does not necessarily equal the cash that you're spending. That's why cash has a separate financial statement of its own. It's called statement of cash flows. So, there are things that affect cash that don't have anything to do with the profitability of your business, and let's just talk about a few of those. So, first of all, let's go ahead and get this started here. First thing, this is rare, but it does happen. Hospitals and basically other practices that are in excess of $10 million a year are recommended to operate. And in fact, I think the Healthcare Financial Management Association recommends that hospitals and major healthcare providing facilities operate their financials on the accrual basis. What accrual means is that when you invoice a patient, you basically count that as revenue. And the same thing with your expenses. When you send out a bill and you have an accounts payable, even though you're waiting for your payment, you basically also record that as an expense at that time. And if you happen to be in the accrual basis of accounting, I don't recommend it for smaller practices, but it's possible you're there, and it's difficult to change the accounting basis of a business. You basically have to write a letter and ask permission, and it's a pain. But main thing is, if you are under the accrual basis method, then you're basically looking at profitability that doesn't equate to the cash because you got claims receivables. And if you're one of the fortunate folks that are able to do your claims turnarounds in the ideal uh, time frame of 53 days, then this isn't too much of an issue, but that's still almost 2 months. And as we all know, a lot of receivables age considerably longer, even over 90 days. So even though past 90 days, they get harder and harder to collect, and we don't want that. But the main thing is this, you may be showing profit that does not equal cash. Okay. And so that's always a possibility, and you need to keep that in mind. Last thing on this is if you are in fact running a practice that's making under $10 million, dollars, you basically are a small physician practice, under 50 employees. Um, we highly recommend if you're making the choice this year to go cash basis. That is when you count your revenue when you actually receive the money, and you count your expenses when the cash actually goes out. So, cash basis is preferable for smaller practices. Now, let's talk about the things that pretty much in common with everyone. One thing is owner draws, and particularly if you are electing to be taxed as an S corporation, money in the bank does not equal money to spend. You have things that you have responsibilities for. Your two biggest expenses are going to be staffing and taxes, and you've got to account for these things for certain. So, if you look at your bank balance and you see several $1,000s in there, it's like, well, I can take 1,000 of that without any other research into whether or not that's viable. You're playing a dangerous game. First thing is, I really like to see people keep the average amount of their monthly expenses as a minimum balance in their operating checking account. That is a buffer against unforeseen, not sufficient fund charges and also other expenses that might crop up suddenly. So, um, the bank balance trap is exactly that. Be careful of it. And also, there's a note down here. S corporations, you pay yourself two ways if you run an S corporation. One is you have to take a reasonable compensation wage. The remainder of the money that's left over after all other expenses, you do pay income tax on, but no other taxes. You're entitled to that money, but you do not want to take more money out of your business than you make in net income in a year. You could find yourself paying an additional tax on the excess distributions. That's right. And you're wondering, how does that happen? Well, the answer is sometimes if you've got yourself leveraged with debt, and we'll talk about that a little bit more later, that kind of creates false cash. And because it's basically a component of capital. So you need to be careful with that. So tax reserves that weren't reserved. Now, first of all, I've been talking about this for weeks now. If you are joining us as a repeat viewer, have you opened that personal tax only savings account that I asked you to yet? You should be making deposits into that every single month. If you're going to owe more than $1,000 in taxes after all other overheads and considerations, you have to make estimated tax payments. Now, the consequence if you don't, nobody's coming to your house and zapping you with a cattle prod or anything, but they are going to hit you where it hurts the most in the wallet, underpayment penalties. Plus, it's something that you want to do because you're basically incurring expenses as you're creating revenue, and you want to take care of those expenses on a periodic monthly basis. You do make the payments in quarterly, so if you have a savings account, you're able to make estimated tax payments from a savings account to the IRS, and almost every state that I'm aware of also has that option. So you should be making a deposit of that every single month. If you don't, you're going to suffer later, you and your cash flow. Okay. Servicing debt. Now, you see a transaction for a payment on, and let's say, for example, you've got an in-office x-ray machine and you're paying several $1,000s a month on that. Well, that is what we call a split transaction because it has two components. You're paying down principal, which is basically reducing um, the amount remaining on a loan. And then the other part of that is interest. Now, the interest expense does touch your profit and loss statement, but the principal portion does not. So this is one of those cash sucks that will basically trip you up if you don't watch it. It is still a cash suck, as I say here. You could be blank ink profit, and I meant to say black ink profit, which means more than zero. But you could be cash strapped as a result. So that's a thing to watch out for as well. So to wrap up, what's the cure for the profitable but broke syndrome? Practices that thrive aren't necessarily the most profitable. You have to have cash. I always think of the cash as a lifeblood of your business. And you know, if you open up an artery and exsanguinate a body, the body is going to die eventually. So, cash is necessary, and you absolutely have to have it for the existence and success of your business. The practices that know where every dollar is right now, where it needs to be next month. And we talked last week about 90-day cash projections, actually. Um, you can't beat that for an ideal scenario for actually uh, succeeding in your business and knowing exactly how where you're doing. Profit and cash are two different things, is basically the bottom line here. Cash flow management is a separate discipline, and it requires its own tools, rhythms, and attention. Now, finally, to wrap up, we're coming to you on one of three different media here. We're on YouTube and LinkedIn as well as Facebook. You may be watching this in either live or on replay on any one of those three. What they have in common is a comment section. If you'd like more help, let us know by just saying help or more information or appointment, and we'll respond to you within 24 hours, and we'll sit down and talk about whether it makes sense for us to work together and make you more profitable in your business and know exactly where your cash is going. So until next week, I'd like to wish you a happy Wednesday. And this is the last Wednesday of winter, as a matter of fact. So think spring, have an amazing rest of your day. And if you have a chance today, do something randomly kind for a stranger. So until next week, so long. We'll see you again for